Good afternoon and good morning to all of you. Welcome to HCL Tech's fourth quarter earnings presentation, which also covers the annual results for FY18. Today I'm joined by several members of the HCL leadership team, some of them in the room and some of them on the call. So let me get started. In terms of an overall financial summary for FY18, from a revenue perspective, we grew 12.4% year-on-year, and for the quarter ended 31st March, we grew 2.5%. From a constant currency perspective, it's a 10.5% revenue growth and 1.2% revenue growth on a sequential basis. Our EBIT margin for the full year came in at 19.7%, and for the quarter ended 31st March, it came in at 19.6%. Overall, this is the second consecutive year of consistent execution of our overall strategy. We've met our guidance and on the revenue and margin for both the years. So we feel very satisfied with our overall performance. It's also signified by some important milestones. We crossed a run rate of $2 billion in quarterly revenues, and for the first time, HCL crossed 50,000 crores in revenue in this year. Overall, we are happy that we have ended the year with industry-leading growth, meeting guidance on revenue and margins. If you look at our performance trends over the last 5 years, a fairly consistent performance, the CAGR of 11.5% in terms of revenue, while the headcount grew 7.3%. Continuing to demonstrate significant nonlinearity in our business model, and this has been further accelerated in the last 2 years, driven by our Mode 2 and Mode 3 services. We've had a consistent growth in EBIT and an even greater growth in our net income, really focused on continuing a stable and a profitable growth trajectory in our business. If you look at the performance in different segments for the last year and the last fiscal, the growth has been consistent and broad-based. Some of the real highlights are 13.3% industry-leading growth in financial services. A lot of this is enabled by digital services, both in our existing clients and in new clients. A lot of our customers are looking at us as a disruptive service provider and are looking at replacing some of the traditional providers with our offerings. The growth has been fairly secular in most other verticals in FY18. Healthy growth across all geographies, led by US, close to 14% year-on-year growth. Engineering and R&D services grew at 37.6%, enabled by all three dimensions, which is organic growth, IP partnerships, and acquisitions. During the year, we reorganized our sales organization, a part of which was already vertical-led from a go-to-market perspective. Now, we have completed the reorganization across the board. HCL sales teams for the IT services are now organized by verticals, and this is primarily done to address the market opportunity on Mode 1, Mode 2, and Mode 3 in a much more cohesive manner, and we expect this to enable a good momentum that is already in progress in the Mode 2 and Mode 3 businesses. Moving on, just a snapshot of how we have performed over the last 3 years in terms of our Mode 1 to 3 strategy. In FY16, we had 15.9% of the revenues coming in from Mode 2 and 3. It increased to 18.6%, and in FY18, it came in at 23.4%. Our Mode 2 revenues grew 29.4% year-on-year in FY18, and Mode 3 grew 68.3%, and a combined Mode 2 and 3 services grew by 41.5%. So we believe our Mode 1 to 3 strategy is continuing to make considerable progress, and the results are very visible by the growth metrics. We signed 15 transformational deals in Q4. It consisted of all our services, geographies, and verticals. For the year, we signed about 63 transformational deals. As we had indicated earlier, we are seeing a strong increase in the number of deals and the deal sizes in our Mode 2 services. And just an indicative metric is 26 customers in Mode 2 with revenues greater than $10 million in FY18, together contributing to 49% of our Mode 2 revenues. In Mode 3, we continued our initiatives. We launched the first wave of managed services edition of some of the products. Apart from adding several products to our portfolio through a mix of homegrown organic IP acquisitions as well as IP partnerships. Moving on, a quick view of how our client partnership program has progressed. We have demonstrated a significant growth in our top 5, top 10, and top 20 clients. This has happened across different geographies and verticals. We continue to increase our wallet share for many customers where some of the traditional programs are being optimized and the spend is being diverted into some of the next generation services. So this is clearly a strong success metric, and we continuously track this to see how we can fine-tune and continue to improvise on our client partner program. I want to cover a couple of inorganic updates. The first one is C3I. And the strategic rationale is pretty similar to what we shared earlier. C3I is a leader in customer engagement services in life sciences and consumer packaged goods industries. They have very special capabilities in clinical pharmacovigilance and pharma sales support domains. We believe that HCL's Mode 2 digital capability combined with C3I's depth to be more patient-centric will help us to offer services to IT as well as business stakeholders to improve healthcare outcomes. I think one very strong strategic rationale is our ability to access business stakeholders in several client organizations, in addition to the CIO organization, was one of the prime drivers. The second element was also this has given us access to a lot more pharmaceutical clients and a few select top leading brands in the CPG industries. As we had disclosed, the revenues of this organization has been coming down in the last 3 years at approximately a 10% decline rate. So in our outlook for FY19, we've factored in a decline of about 10 to 12%. We believe there are good opportunities to grow these services. We expect the growth momentum to pick up in FY20. In the current construct of C3I, due to the parent company, several other pharmaceutical companies did not outsource work to this entity because of the competitive nature of the parent company with some of their businesses. We believe this will unlock some synergy and we will find some new growth opportunities. So we expect growth to be coming in FY20. The margins of this entity is very low. We said EBITDA margin of 6%, and the EBIT margin would be a couple of percentage points lower at this point. We expect the margins to reach HCL company level margins in 3 years. This will happen by a combination of growth in revenues, which we think will happen in FY20 and 21. And there are also significant cost out opportunities which are there in some of the SG&A line items. All this together will contribute to improving margins over the next 3 years. On the next acquisition, Actian, primarily our focus and the strategic rationale for acquiring or designing a definitive agreement to acquire Actian is primarily our interest in the area of data. We believe hybrid data management is a very important area, and as more and more hybrid operating models come into place, with some of the landscape on-premise and some landscape on the public cloud. So Actian owns several market-leading products as Actian Vector, Actian Data Connect, and Actian X. Some of them are extremely rated highly from a performance perspective. We believe it enhances our Mode 3 offerings, and when combined with some of the HCL's Mode 2 solution offerings, it offers a powerful proposition to harness the power of hybrid data. In terms of financial outlook, the regulatory approvals are in progress. We expect this to complete by August 2018. In terms of revenue trajectory, though it's been declining for the last 2 years, we expect the revenues to be stable because we're already seeing some growth in the second half of the FY18. So we expect revenues to be stable in FY19 and growth expected in FY20. So now I will hand it over to Anil to provide some additional commentary on the financials for the past year.
Thank you, Vijay. Hello, everyone. Good morning, good afternoon, good evening. So a quick recap on the performance. So very strong quarter. We grew by 2.5% in reported terms, and this was on the back of a very strong quarter, the October to December quarter, where we grew by 3.1%. We crossed 2 billion as a milestone on a quarterly revenue basis. In constant currency terms, we grew by 1.2%. There was a very strong client addition on a year-on-year basis. So there were 3 new clients added in the 50 million plus category and 6 in the 40 million categories, 9 in the 30 million categories, and 55 in 1 million plus category. So strong client addition across categories. On an annualized basis, we grew by 12.54% year-on-year. And on a constant currency, it was 10.5%. As Vijay said, this was within the range, the guidance range we had explained. Going to the margins this quarter have been flat at 19.6%. There has been a variation in the margin between the service lines. The software services margins declined this quarter. Software services comprises of applications and engineering services. The infrastructure margins improved this quarter, and there was also improvement in the BPO margins this quarter. The software services margins, as I said, comprise of both the engineering margins as well as the product and platform margins and application business margins. There is an element of seasonality when the October to December period, the margins in the product and platform business significantly increased because there are a lot of renewals which happen in that quarter. Generally, if you look at just July to September quarter, the software services margin was at 20.2%. It went up to 21.3%, and in JFM quarter, it came to 19.5%. So one of the questions I got during the day was why there is a variation, and this variation is due to the seasonality and also to some extent due to higher payroll taxes in the U.S., which normally hit in the first quarter of the calendar year and then go down from there on. For very similar reasons, the SG&A also increased by 80 basis quarter-on-quarter, higher payroll taxes, higher CSR expenditure in this quarter, and certain legal and professional costs associated with the M&A activity which happened. On an annualized basis, on the margin side, we have been within the guidance range of 19.5 to 20.5%. Our net income went up by 7.7%, while our revenues went up by 12.4%. With respect to I touched upon the shareholder return. So while you see the net income growing by 7.7%, the earnings per share, if I remove the impact of one-time tax benefit we got in the financial year 17, the earnings per share increased by 9.4%. There was about 46 million of benefit which came in the financial year 17. The return of equity stands at 25% plus, so pretty good return on equity. In terms of payout, we continue to will be paying out 50% of the net income we generate, and this is is what we have stated that we will be striving toward. With respect to the effective tax rate, we expect the tax rate in this FY19 to be between 22 to 23%. With respect to hedging, there has been a good performance of hedging. For the full year, the net exchange hedge gain has been 83.5 million, which is more than 1% of the revenue. And this quarter, it was 24.6 million. We continue to follow a layered hedging program. And we have mark-to-market gains of 26 million and the held-to-maturity gains of close to 100 million in our balance sheet. Going further, in terms of cash flow generation, the net income to operating cash flow generation has been 123% in the full financial year. It was higher in this particular quarter at 123%. With respect to cash, the EBITDA, free cash flow to EBITDA ratio, this has been for this particular quarter has been at 80%, while for the financial year it has been 65%. A quick sort of a note on, in fact, I was asked a question whether we have done any IP deals this quarter and whether there is any payment relating to any new deals this quarter. There has not been any new deals this quarter, and no new payment has been recorded. So whatever payments are recorded are relating to the deals we had done earlier, because the last deal, so we have about 200 million odd still payable against the deals which we had signed in the earlier quarter. We will be enhancing our disclosure going forward, and couple of with respect to verticals, we will be making small change. We currently classify the manufacturing and high-tech together. We intend to sort of align high-tech more with the telecom, media, and technology, the MT segment, rather than the manufacturing segment, because there is a lot of synergy between the two. So it will come as part of the telecom, media, entertainment vertical. This we will be sort of giving going forward. The other change we will be doing is we will be providing you the mode 1, 2, 3 revenues every quarter, so that you can see the progress what we are making with respect to each of these modes of services we are offering to our customers. We are also trying to work out at a certain level, either at a gross margin level or a we are still figuring out, trying to work out through our ERP system what is the data we can provide. We'll come back to you on that. There will be certain disclosures which over a period of time have become redundant, like bank-wise cash details and facility details, etc., which we will be discontinuing. We will be engaging with you before sort of making changes to these disclosures during the quarter, and then make the changes going forward. One of the items I would like to touch is there have been questions during the day with respect to our guidance, and I will try to answer them. And to the extent I'm unable to answer, we will cover it in the Q&A going forward. And I would also request Vijay to step in as I am explaining here. So with respect to revenues, we expect our revenues to grow between 9.5% to 11.5%. This is using the average exchange rate for financial year 18. If I use the March end exchange rate, this works out to 10.5 to 12.5%. This includes both organic as well as inorganic contribution, which is likely to flow in this 9.5 to 11.5% range. There are 2 acquisitions which we have already announced, the acquisitions being the HCL and C3I. While we are doing this, we will be doing this acquisition, we also have we had informed you that India business is where we are sort of reducing our emphasis. And there will be a further decline in the India business, which will be happening. So there will be a net sort of impact of both of these on the overall revenue. So there will be a positive flow which will happen from the new acquisitions which we have done. And then there will be a negative so far as the India SI business reduction is concerned. There is also, we did some acquisitions last year, where the revenue benefit didn't flow for the full year last year. So part of the benefit will flow in this year. So net, we anticipate for whatever we have inorganic activity we have done so far, or committed through CCI acquisition and HCL acquisition, there will be a 400 basis point benefit which will flow. If I use the middle point of the range, which is 10.5, so 5.25 is supposed to be coming from organically and 5.25 is supposed to be coming from inorganic. So 4% will come from, as I explained, from HCL, CCI, and the last year acquisitions as adjusted for the decline in the SI business. So about 1.25% of the inorganic revenue which are yet to come, for which the deals are in the pipeline and which we will be sort of announcing as we are finalizing those deals. And we are very confident that we will be meeting that 5 point, the mid. I'm just using that midpoint for this purpose, which is 5.25% in organic growth. This could be 4.5 to 6.25 because this is the range we have given to you. In terms of margins, we expect our operating margin to be between 19.5 to 20.5%. This is the same margin range which we had sort of taken as a target last year. It assumes the currency, the average exchange rate for all the currencies other than in the USD INR, which is at 66 rupees we have taken. And we have factored in the impact of CCI, which Vijay just explained, where will be some sort of the margins are bare minimum, and we will be improving the margins as we go forward. I have already sort of told you about the tax rate, which will range between 20 to 23%. So this sort of gives a complete color on the guidance, and we'll be happy to take any questions as we move to the Q&A. Would you like to add something?
Yeah, I think you covered all the elements. Maybe now I will request, before we go to Q&A, we have a couple of more sections. We wanted to provide an update on a little more details on the progress that we are making in Mode 2 as well as Mode 3. So we will have Anand Vijay talk about overall Mode 2 updates, followed by Darren and a quick HR update. After that, we will go into Q&A. Over to Anand.
Thank you, CVK. Good day, everyone. As CVK talked about earlier, this has been an inflection year for us, the past year, for the Mode 2 services. And I thought it might be appropriate to kind of recap something we had done 3 quarters ago, help explain what Mode 2 services comprise of and how they work in enterprise digital transformations, creating business outcomes for enterprises. So there's a slide that was kind of put together to demystify that. And, we always talked about digital and analytics, cloud, IoT, and cybersecurity as those core pillars, the 4 services within our Mode 2 services that are enabling enterprise digitalization. And if you look at it, really what it means is enterprises are rethinking their value chains, their business processes that are critical to be innovated upon so that they can business transform and stay sort of ahead of the market and compete in the market. And on these value chains, they are rethinking these value chains with human-centered design, with user experience at the core to reimagine processes in these value chains, whether it's the user value chain in how they interact with their users, internal users, external users, and their consumers, their asset value chains depending on the industries they are in, or their service value chains. And so user experience-based process rethink is the core capability that we bring that is allowing us to work with enterprises on these value chain rethink. But the enablement of these value chains is happening through composable digital platforms that are getting built with API and microservices at the core, new technologies such as AI and blockchains and virtual reality and augmented reality at the core. And really at the base of it, data as a fabric. CVK talked about our focus on data because the increasing importance of data as a foundation to digital transformations, both building data as a fabric and then really using insights from the data, whether the data comes from the business operations or from the machines and things that are in the enterprise, is a very important element of our analytics strategy. Obviously, we've always been a deeply involved embedded systems provider on the devices side, and so our IoT Works capabilities are a very important element of digital transformations, both in terms of integrating the devices in the value chains and getting insights and data from the devices in transforming these value chains. As digitalization is happening in the enterprise, the profiles and the security profiles of the enterprise are changing, and our focus on dynamic enterprise postures and creating new cybersecurity services for enterprises is an important element of digital transformations. And finally, the foundations of the enterprise are also transforming and moving from on-prem discrete infrastructure to cloud and cloud-like infrastructure or SDI infrastructure, and our cloud topology and cloud-native services are helping enterprises sort of rebuild their foundations as they digitalize their value chain. So again, to recap, digital and analytics, IoT Works, cloud-native services, and cybersecurity services are really becoming the pillars of our Motu services in digital transformations of enterprises. Some of the commentary on Motu, some detail in terms of where the growth came from and what are we seeing in the market. As I said, a lot of the growth is coming from 3 or 4 of these services coming together in helping enterprise creating those business outcomes, those digital transformations. CVK mentioned earlier, we had a fairly inflection and healthy year last year, 29.54% growth year on year in these sets of services led by digital and analytics. What was more important was we had extremely healthy wins, 40-plus wins across verticals, across geographies, across U.S., Europe, and Asia-Pacific geographies. And quite a lot of these wins came from net new customers where we were displacing traditional vendors who were providing traditional IT services in these customers. Another important aspect, and this is also a change that is happening in the market in the last few years, is enterprises moving away from digital programs and digital projects to really ongoing scale digital partnerships. And so a sufficient amount of our experience in that area has helped us over the last few years, where almost 26 of our customers are in scale digital partnerships with us, where we are not just delivering projects, but multi-year digital programs across digital, cloud, IoT, and cybersecurity services. Some of the investments that we've made, that we've talked about in the past, but we wanted to highlight and give some color to that on the last slide, really, both in terms of building new capabilities organically and building new technology and lab infrastructure that are very, very core elements of digital transformations that enterprises seek. We've invested over $100 million over the last 2 years in building a variety of labs across U.S., Europe, and India. Experience-centric labs for process redesign, IoT labs for sensors, transducers, and IoTization of enterprise business processes, cloud-native labs for cloud-based modern app development and cloud transformation that enterprises are embarking upon, and then more specific labs like imaging and industrial design lab or cybersecurity labs that we built across the markets. These labs are also places where enterprises are coming to do co-innovation, prototyping, POCs with us in the start of their digital journeys or during their digital journeys. We also really robustized our capabilities in design and user experience, bringing in leaders, bringing in practitioners and subject matter experts from the industry who came from mainstream design agencies, from mainstream marketing transformation agencies across the world, and they have become critical elements of our design studios and digital labs across the world. With that, I'll hand this back to CVK. Thank you.
So over to Darren for a quick update on Mode 3.
Great. Thank you, CVK. We thought as we close the fiscal year and as we embark on the new one, it might be a good opportunity just to set the context on our Mode 3 strategy in terms of where we are and where we're going. There's been a lot of interest over the course of the last several quarters with all the activity that we've had in the market from various IP partnerships and acquisitions. And so we wanted to give just perhaps a broader view of how we're stitching together these various initiatives and investments into a much larger strategic transformation. So when you take a look at what are some of the key elements of this strategy and where are we looking to go, it is guided by a set of core principles. And first among those is that we see this as a long-term transformational play for HCL, really instilling IP DNA across the organization, whether it's within our Mode 1 and Mode 2 service offerings or in new products and assets that we'll be bringing to market directly. And it is a multi-pronged strategy with multiple ways to win. And this is very consistent with the way that we've looked to incubate new businesses throughout our history. It's both about diversifying risk. It's also a way that we can accelerate entrepreneurial energy, building capabilities both organically as well as through a whole series of inorganic activity and across multiple parts of HCL. Our commitment, and I think it is important to emphasize this, is we see this as a win both in the short term, something that has benefited HCL in FY18, will be a benefit from both the revenue and profitability in FY19, but really in terms of the long-term value. And the long-term value we'll get into in some of the details to follow, but really how we start creating more transformational and new offerings for our customers and our partners. And then finally, I think on this slide, just wanted to emphasize the fact that it's not a single strategy. This is something we're looking at technical areas across all of HCL's service businesses, both in terms of horizontal technologies, areas that play to core competencies of ours, like IT automation, DevOps, data and analytics, legacy modernization, collaboration, security, but also vertical solutions as well. Whether it's in the banking industry, telecom, or in other vertical areas, these are areas where we're looking to harvest and develop organically and inorganically key vertical solutions. In terms of some of the updates, we've highlighted in the discussions that have preceded this, some of the investments that we've made, the new acquisition of Actian. We've also highlighted on a quarterly basis the IP partnerships. I think what I just wanted to take a moment to emphasize, and do that on the next couple of slides as well, are all the organic capabilities that we're building. And this is both capabilities that have existed within and across HCL, buried within our service practices, but also additional investments that we're making in building up the talent and skills and capabilities across the end-to-end software product value chain. Now, next, if you move on to the next slide, we wanted to give a slightly deeper view of this. And again, the key phrase that I would emphasize is multidimensional. We're not looking at this in a monolithic way. We're not looking at it as it's about IP partnerships or it's about acquisitions. We're really trying to think about this in a holistic way of how we can incubate and develop capabilities towards this long-term transformational vision around Mode 3. So I wanted to give you a view perhaps and just segment into three major blocks. The first block is all the work that we've done in harvesting, developing, and extending IP assets that have been created across HCL. Whether it's in our infra practice around next generation IT service management, within ERS, and a lot of the capabilities around DevOps, testing excellence, application development practices, within our application businesses, within our various verticals, both harvesting, incubating, developing, and investing in innovation assets. And we've been organizing this business under the overall framework of dry ice, where we have really leading-edge capabilities with a focus on next-generation service management and delivery, autonomics, lots of capabilities we've been building around AI, machine learning, and how to really push the envelope for the next generation of IT and cloud automation. The second major sort of thread that I would highlight is the products and platforms capability, which houses today the major IP partnerships focused on 5 major areas. DevSecOps, really the integration of the application development tool chain with application security, automation, collaboration, mainframe and legacy modernization, and then data and marketing platforms. These are the 5 major core, proven, scale products and platforms within this business unit, and really focused on a playbook that we've developed over the years within HCL of energize, modernize, and innovate. And what we've seen through the course of the various IP partnerships that we've done is significant and concrete improvement, both in the underlying capabilities of the product and the associated revenue curve and value that customers are seeing from it. In conjunction with this, we've been building a lot of the wraparound capabilities that are fundamental to building a long-term successful product business. Whether it's product management, product marketing, capabilities around UI and UX enhancement, and building modern experiences around a product portfolio, cloud enablement, product sales, and professional services. And then finally, the third major pillar here on the right is a whole series of investments and initiatives that we have across HCL. We've highlighted Actian in previous quarters. We've highlighted acquisitions like Alpha Insight, Geometric, investments that we've made in leading startups like MoveSoft, some of the vertical software capabilities and IP partnerships associated with that. Again, the key point I would emphasize here is we've been looking at how we can clothe, how we can incubate all of our service lines with Mode 3 offerings in IP-intensive businesses. I think the summary from this is, what we see this as a long-term strategy around future-proofing our business and over time building transformational solutions and capabilities across all of HCL. And then finally, I think what we're going to be highlighting over the quarters to come are increasingly a lot of these proof points in terms of new capabilities that we're bringing to clients, as a result of these various initiatives. So if you move to the next slide, we just wanted to take a minute, and this is perhaps very high level, but we thought it was worth, calling out and emphasizing a lot of the enabling capabilities that we've been building. From an investor point of view, you've heard about an acquisition, you've heard about an IP partnership. What's perhaps less visible is all of the connective tissue that we're building internally through hiring and developing of new talent and new skills into the organization. So a lot of the areas that we've been focused on in terms of initiatives are things like product packaging, it's product management, it's new and innovative licensing models. It's building a lot of the capabilities to be a leading-edge product provider for the future. And so a lot of these initiatives and a lot of this work are going to be coming to light over the course of the next several quarters. We just wanted to take a moment to perhaps cast a light on this in conjunction with a lot of the inorganic activities that have been featured more prominently. So with that, I'll turn things back over to CPK.
Yeah. Appa will cover a few updates on our HR, and then we'll go to Q&A. Over to you, Appa.
Thanks, Darren. Thanks, CPK. A quick update on the HR front. We had a fairly decent year in terms of attrition. We exited the last 12 months, we are at 15.4%. This is a good 140 basis points improvement over FY17. Our increasing employee connect and engagement is helping us. And the other thing is the growth what we are seeing in Mode 2, Mode 3 areas requires a fair amount of skills at scale, which we are not finding in the market. Whatever little we are finding is coming at a very high cost. So to accelerate the skills deployment into the new wins what we have,
So we started a very accelerated move to training program. And in FY18, we have trained approximately 27,000 people, and 90% of them are deployed gainfully in various engagements. And we will continue to accelerate this program so that it's in line with our growth aspirations in Mode 2 and 3. We also have embarked on a huge technology intervention for HR automation processes, whether it is talent acquisition, talent development, or talent management. So today we have pretty much integrated our talent acquisition part. So from requirement raising to onboarding, we have already cut the cycle time by 13 days, and we hope to increase this a little more and probably come below 15 days in terms of recruiting, which will help us in terms of accelerated acquisition of talent. So workforce transformation and workplace transformation are areas where we are focusing. As part of that, we took up a slew of measures on improving the gender diversity, and we moved the needle a little, and today we stand at 24%, and we would like to continue this focus in the coming year. And US, we have been quite heavily focused in terms of localization in various geographies with all the incumbent problems we have in work permits and visas across the globe. And in one particular instance, US, we were able to increase our localization from 52% to 58%. And we expect this to go a little further in FY19. And the amount of automation, what we are doing, efficiencies, process streamlining, we continue to improve the revenue per employee, which has increased by 5% to $66,000 in over FY17. So these are briefly some of the updates on HR, and I'll pass it to CVK.
With that, we can take question and answers over to you, operator.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. The first question is from the line of Ankur Rudra from CLSA. Please go ahead.
Hi, thanks for taking my question. Also, thanks for the detailed presentation today. Just a question on the performance and the guidance. The organic constant currency growth appears to have slowed down a bit, over the course of FY18, and especially in the last 2 quarters. Your guidance does not appear to bake in any kind of acceleration in organic growth. I think you said 4.25 to 6.25. Is there a reason for caution, even though your client relevance appears to be improving and the success of your Mode 2 and 3 strategy that you've been highlighting? If you can elaborate on that, and also specifically if you can highlight what is the drag from India baked in for FY19, what it was in FY18 as well. Thanks.
Maybe you can address the India, and then I will forward on to you. Sure. So India has been about, I would say, about 1% in financial year 18. But it will come down, further come down, because we have seen this, because of the fact that we have not participated in the SID. I see it sort of almost significantly sort of reducing there. So that is one. Yeah. So I think from an overall organic growth perspective, while we continue to remain very positive about the traction in our Mode 2 and Mode 3 services, as well as the traction in winning new logos in traditional services, we also have a large book of business, and there is a renewals pipeline which is there. So basically, the level of compression in the existing book of business is driven by the volume of renewals. So I think if you just factor that in, that kind of little bit accounts for some improvement. I mean, we have factored a very similar levels of organic growth, accounting for some compression in the renewals based on the volume of renewals that is expected, or even renewals that happened in the last half of the last quarter. So all of that overall provides an outlook, as Anil highlighted, around 5.25% organic growth in FY19.
And in the foreseeable future, if you look at for the next 2-3 years, CVK, is it fair to assume that that level of compression will stay in your business, or will that slow down or accelerate in terms of the headwind you face from these renewals?
Okay, Ankur, we have not very precisely estimated the impact in FY20 and 21, but just looking at by common sense overall the book of business and it goes up to that extent, the pressure on renewals will be there, because with every renewal there is more expectation on productivity, more expectations on automation, some amount of cloud migration, not just in the infra business but also in the software business, some applications moving to SaaS. All of that makes the renewals a little smaller, including new deals a little smaller. So I would say there will be a slight increase in this as we move forward. But I don't have a very precise estimation of this. This is just an thumb rule answer that I give.
Okay. Thanks, and best of luck.
Thank you. In order to ensure that the management is able to address questions from all the participants in the queue, we request the participants to please limit their questions to up to one. Should you have a follow-up question, we request you to rejoin the queue. The next question is from the line of Divya Nagarajan from UBS. Please go ahead.
Hi. Thanks for taking my question, and thanks for the presentation as well. My question is to CVK. How do you think about longer-term organic growth momentum for the company? Do you expect as these renewals, the pressure from the renewals starts to ease, you should be able to get to a high single digit or possibly even an early double digit kind of growth rate here? If yes, which segments in particular will drive that growth, or do you think that is now not the case anymore, and to kind of maintain these double digit growth rates, there will continue to be a certain reliance on M&A? How are you thinking about it in a 3-year, 5-year kind of view?
Yeah, I think, first is we have done a very careful estimation of what is expected to happen in FY19. I have not done a good forecast of FY20 and 21 and even longer term. But I think the true growth will accelerate only when our next generation services are really going to be the growth drivers. In the traditional business, we will continue to gain new logos, but the deal sizes are becoming smaller. So I think the growth momentum in existing services, I don't see it accelerate in the near term. Maybe a marginal increase or a decrease, but the real growth is really expected to, incremental growth will come from next generation services.
Got it. Thanks. I'll come to follow up later then.
Thank you. The next question is from the line of Ashwin Mehta from Nomura. Please go ahead.
Yeah, hi. Thanks for the opportunity. So, CVK, just want to check in terms of, we had earlier indicated that IMS would improve from 1H. Do we still stand by that expectation? And secondly, what exactly is driving the deceleration in terms of app services? Because our legacy exposure in app services should have ideally been lower compared to our peers.
Yeah. So, Ashwin, first is on the infrastructure services. I had highlighted that in H1, we will see a pickup in the growth. I think we stay with the same commentary. Depending on the deals that is closed in the second half of FY18, I do believe in FY19 it will accelerate. But overall, India is going to create a little bit of dampening effect to the infra business, probably in FY19 to some extent, but after that it will not be the case. So I'm not able to provide a very precise how much will infra business grow in FY19, but it will definitely be better than FY18 because we are seeing all the trends in line with the growth momentum, barring the fact that the deal sizes are becoming smaller. So that's going to kind of overall reduce the growth rates, but it will definitely be better than what we had in FY18. From an application business perspective, I think there are three elements, as I said. The traditional application support, the component of that is fairly small, which is facing similar kind of dynamics like infrastructure business, more around automation and more around some applications moving to cloud. Our enterprise package, while we saw some growth and we continue to see some growth in on the cloud implementations, but traditional large implementations are not happening. So I think some growth in next generation services is getting offset by some of the ASM compression and large SAP type of transformational programs not happening at the same level as it was in the earlier years.
Okay. And just one small one from Anil. Anil, the licensed IPR gross carrying value seems to have gone down by around 20-odd million. Wanted to check what is the reason for that?
Could we exchange? I mean, that's what I can think of. I don't have the exact numbers in front of me, but we can certainly talk offline. But could we exchange will always have an impact. Yeah.
Okay, fair enough. Thank you and all the best.
Thank you. The next question is from the line of Ashish Chopra from Motilal Oswal. Please go ahead.
Yeah, hi. Thanks for the opportunity. CVK, just wanted to understand from you, I think some of the examples that you cited in the mode to services in cloud native, the deals, particularly referring to the 3 deals that were mentioned there. So could you just throw some light on were these existing IMS customers which are now into the cloud native services, or are you kind of winning new customers as far as the IMS cloud business is concerned? And the second question around that was just in terms of the deal sizes, how the dynamics changed, not to know the sizes of these deals, but just to get a clearer understanding of an incumbent account that goes into a cloud native services. What's the kind of compression or addition that you are able to get when you are actually offering migration of workloads to the cloud?
Okay, sure. Let me take the cloud native services question. I think we announced 3 deals on cloud native services. One was a professional services firm based in Europe. This was an existing client where we provided data center services. So here we are migrating the large part of the data center, maybe 70-60% of the data center to cloud. And for that component, it was approximately half in terms of the existing revenues to the new expected revenues. The next one was Europe-based pharmaceutical company. This was an existing client, but a small part of the estate is moving. It's a large pharmaceutical company. So I think the impact of this migration would not be much. It's probably less than 15% of their estate, which we expect to migrate to cloud. The next one is a US-based company. I don't have the exact details on this. I think this is a new client where we have a net new client where we are doing cloud migration.
Sure. And just one last one from me on IMS. So I think last year in the first quarter you had mentioned the impact of productivity benefits kicking in a large deal like Volvo. Should we kind of bake that in our 1Q expectations from IMS, or does that no longer have a material impact?
No, yes, in April we have the same impact. because last year in April, AMJ quarter, we had a reduction, year-on-year reduction as a part of the overall program. That is definitely there in this year as well. Maybe the quantum is not the same as last year. It's a little lower, but it is there.
Okay. That's it from my side. Thanks a lot and all the best.
Thank you. The next question is from the line of Ravi Menon from Elara Securities. Please go ahead.
Hi, thank you for the opportunity. The first question is on Europe. In the wake of the Volvo deal, we were expecting to see better traction, probably higher win rates over there. But this year's growth momentum over there still seems to be slightly slower than what we had anticipated. Anything subject to probably some of the deal compression that we're seeing in Europe in renewals?
Sorry, what was the question related to Volvo? I didn't get it.
So post Volvo, we're expecting that your win rates in Europe would go up, and therefore, we might see better growth overall for Europe compared to Americas. But this year it seems like America has done way better than Europe. Is Europe existing revenue kind of under pressure from renewals?
I think from a Europe perspective, in the second half of FY18, we definitely saw the win momentum significantly increasing. The number of deals that we won in Europe in the second half of FY18 is significantly higher. It's probably among the highest. But the deal values are significantly smaller. So I think that's primarily because some of the clients by nature are smaller clients, and also the new deals are coming in with the assumption of 30% or 40% public cloud component as a part of the overall outsourcing deal. I think that's what is showing some weakness. But I expect FY19 Europe to be better from an infrastructure perspective, certainly, than what it was in FY18.
Right, thank you. And secondly, we did talk last quarter about some synergy revenue starting to come through into the services side, from the IP deals. I assume that should come in the application services. So should we expect to see slightly better growth for application services in FY19?
Actually, Darren can highlight a few wins that has happened. However, the revenue impact of that may be marginal. So, Darren, you want to highlight some of the services deals that we won in alignment with the overall IP partnerships?
Yeah, I think that's exactly right. So we're certainly seeing a good volume of customer uptake of product-related services. But in terms of the aggregate revenue impact, it's still relatively small. And you would see it both as standalone deals, so times going in and working with a customer around implementation, upgrade, training, and integration. In some cases, some small managed services, where a customer is looking for a hosted solution or some form of premium support or custom development work. So you will see some of those as standalone deals. We also are beginning to see customers that are traditional application services or ASM customers of ours, expanding and finding additional growth opportunity to start bringing product-related professional services into those much larger ASM programs. So it certainly falls into both categories, but at least as of today, the aggregate revenue impact is still relatively small.
Right. Just a small follow-up over there. I can understand that the aggregate revenue impact and the deal sizes are fairly small for some of the deals that you've taken on from, or some of the software that you've taken on from large, I would say, software vendor sorts or a system integrator. But for the vertical specific software, shouldn't the deal sizes be much larger from the services component, I mean?
I think in general that is true. With vertical applications and more business-oriented applications, the deal sizes will be larger. I think with a lot of the more horizontal and infrastructure-oriented tools, the deal sizes, you'll see more of them, but the relative size will be a lot smaller.
All right, great. Thank you, and best of luck.
Thank you. The next question is from the line of Sandeep Shah from CGS-CIMB. Please go ahead.
Yeah, thanks for the opportunity. CVK, I think post the Q3 result, in many of the interview comments as well as earlier comments, you said that the FY19 growth would be better than FY18. But if you look at your guidance, it actually been lower at the lower end versus what you grew in FY 2018. So what has changed post your last comment and giving the guidance, despite you added 2 new acquisitions being announced post your Q3 results?
I think in terms of new deal wins and the momentum that we are seeing and the optimism, I continue to remain optimistic. But when you really factor in the existing book of business and the impact of renewals, this is where we believe we will land. So that was the real basis of our guidance. But as we progress, we will continue to keep you updated on how we are doing on this.
Okay. And Anil, can you just once again clarify the guidance portion which you actually given in the initial remarks and your presentation? Can you once again give us?
Sure. So Sandeep, we're talking about the revenue guidance here. So revenue guidance in constant currency term is 9.5% to 11.5%. I'm picking up the middle of the range, which is 10.5%. We have that 2 acquisitions we have announced, which is the C3I, which is already consummated, and XTN, which we are hoping will conclude by August this year. So we will have 7 months of revenue flowing from XTN. And then there are acquisitions which were completed last year in the course of the year, for which the residual full year benefit will flow in this financial year. So all put together, and the impact of India's SI decline is a net 4%, sort of inorganic. So if I take 10.5 being the middle of the range, 5.25, I'm just cutting it exactly half. 5.25 is organic and 5.25 is inorganic. Out of which 4% is already in a way done, assuming Actian closes in August. And so we will be sort of doing further, will need further inorganic revenue of 1.25%. And the rest, which is 5.25, will be the organic growth. Since I picked up the middle of the range, this will be 4.25 to 6.25%. So, I'm just making it a more mathematical sort of equation, of course. There will be rounding out here and there, but this is what it looks like today.
Okay. And to further add to it, there are many assumptions which has gone into arriving at this guidance. So I think at this point, you should take this as an overall kind of an estimation from a thumb rule perspective, since there was a lot of emphasis on organic, inorganic in some of the questions that we received.
Okay. Just a follow-up in terms of the IP investments. This quarter, there has not been any partnership announced. So how should we read in terms of the intent? Are we done in terms of the portfolio where we wanted to have those kind of an IP? Are we done with that, or are we looking for more such kind of an investment? And second follow-up, CVK, if we just look at the growth of these standalone IPs, it would be mid-single digit. So at a board level or at a company level, how you actually quantify the synergy benefits on an ongoing basis, whether these investments are moving in a right direction or not? Because just for 2-3% or a 4% kind of a growth, such a price to sales multiple of 3.5 times looks really expensive, even with the IRR of 15-16%, when the actually alternative investment in the digital companies, the growth could be upwards of 15-20%.
Yeah. So we continue to look for growth opportunities, inorganic opportunities in Mode 2 and Mode 3. It just so happened that last year it was a lot more skewed towards Mode 3. However, we remain very optimistic about some of the possibilities in Mode 2 during this year. And in terms of overall business case, we have I mean, there are many products, different products drive different types of dynamics, and we have made those assumptions, and we believe overall, I think we finished 6 quarters in some of the products, some of them 5, and we are tracking to the business case. But the best way to really look at or review an investment will be at least after a year completion. So for the first 2 investments that we have made, one we are very close to the business case, and another one we are much better than the business case. The second, I think the first question that you asked was, are you done with the IP investments? The answer is no. This is, as Darren explained, this is really a long-term transformational initiative that we have, both organic and inorganic IP, as well as acquisitions. So we continue to look for right areas where we can invest in acquisitions as well as IP partnerships. So as and when we succeed, we will keep you updated.
Okay. Thanks and all the best.
Thank you. The next question is from the line of Anik Mitra from Stewart and Mackertich. Please go ahead.
Good evening. Thank you for taking my call. I have a question like, in the ER&D space, can you throw some light on your business in ER&D space in terms of your geography-wise presence as well as your outlook on ER&D space? And what are the verticals you are serving in ER&D space?
Yeah, G.H. Shaw is on our call, who heads our engineering and R&D services. G.H., would you want to answer that?
Yeah, so to answer the first part of the question, today we are mostly tilted towards North America in terms of geography presence. However, we do see good traction in Europe, and we have very strong presence in Japan. So these are the 3 geographies in which ER&D services are present. Secondly, from verticals perspective, I think we have very broad-based exposure, right from telecom to online to aerospace, medical devices. We are pretty much there with a very good critical mass, and the distribution of our revenues are very decent across all the industries in ER&D space.
Okay, sir, one more question. Like in terms of recent H4 visa policy, do you think that it might impact your revenue growth or business going forward?
We don't see any significant impact of H4 visa policy here. We have been already having more locals as part of our workforce, as part of the overall HCL's policy, so we don't see any impact now.
Okay, fine. Thank you so much, sir. Best of luck.
Thank you.
Thank you. Ladies and gentlemen, this was the last question for today. I now hand the conference over to Mr. C. Vijayakumar for his closing comments. Over to you, sir.
Yeah, thank you. Overall, we've had a good year, and I think we are very happy with the way we've executed and the direction in which our business is moving. All the right metrics in terms of what we want to achieve, we are progressing. Organic and inorganic both remains a core part of our overall growth strategy. However, we are very committed to continue to maintain the return on capital employed as well as our margin profile. So with that, I continue to remain positive on what we can deliver in FY19 in line with the guidance that we have provided. So look forward to interacting with you through the year, and thank you very much for joining the call today.
Thank you very much.